Hello, everyone. Today you're going to learn about the US dollar, gold, and inflation to help you navigate these volatile times so as to protect your family, your hard-earned wealth, and to share what you've learned with your community. You won't hear what we're discussing on today's show in the mainstream financial media. My name is Emil Kalinowski, and this is Making Sense, a Eurodollar University production. Joining me, as always, is Jeff Snyder, the head of global research at Alhambra Investments, a gentleman that reads Federal Open Market Committee meeting minutes, a gentleman that understands the Treasury International Capital Report, a gentleman that if you woke him up in the middle of the night and asked him, what are the bond yields in the United States for the 3-year, he will tell you. Jeff, good morning.
Yeah, but I wouldn't suggest waking me up in the middle of the night. That probably wouldn't end too well because I really do like my sleep.
But I bet you it's possible. I bet you know it. There are a couple of your articles that you wrote recently. You end your articles in kind of it would seem like a non sequitur to people who don't know what's going on. You end your article saying, bond yields are here. Bond yields are here. And in our first review, we are going to be discussing something that has been traveling in bonds company, and that is gold. And you had an article, you wrote it, and you wrote it on July 21st. It's a blog post at Alhambra Investments, exposing the golden lie. As we record this, I think gold is over 1,900 American dollars. It's approaching its previous record. What motivated you to write about gold?
Well, you just stated it, right? I mean, record high. So it's obviously gold is an emotional topic for a lot of people, especially a lot of traditional types of people who believe in a monetary system that should look a certain way, traditional kinds of capitalism, discipline, these kinds of things. So whenever gold rises, there's specific signals that are interpreted or inferred from the rise in the gold price that I don't think they're being recognized rightfully the way things are happening right now. And so as gold goes up, it's an important signal. You should pay attention to gold, yes, but what is it really saying? And what everybody thinks it's really saying is Jay Powell went nuts with the money printer. Here we go. We've got hyperinflation or some kind of runaway inflationary scenario. Governments are spending like drunken sailors, and it's all going to end up like Weimar Germany. That's the mainstream signal that we're supposed to be getting from the gold price. And it's actually, ironically, it's helping central banks in what they're trying to do because it's exactly wrong.
We're going to talk about that. We're going to talk about the gold signal. We're going to talk about Jay Powell and inflation. Let's start out. You quoted Trading Economics. I'm going to read it right out here. Spot gold rose 0.9% to $18.35 an ounce on Tuesday earlier this week, a level not seen since September of 2011 on expectations of higher inflation due to prospects that central banks and governments around the world will continue to step up efforts to support the economies hardest hit by the coronavirus fallout. What is wrong with that sentence?
Well, what's wrong with that sentence is that gold is rising not on concerns that central banks and government around the world are going to do too much and end up with higher inflation. Gold is up because the market is concerned they'll fail at these efforts to re-stimulate and re-energize these economies through these means. And that's what's really driving gold. And that's why it's it's trading in tandem essentially with the bond market and bond yields and the yield curve. These things are all tied together, and they're pessimistically saying, no, Jay Powell's got it all wrong. Christine Lagarde's got it all wrong. The risks are rising. This stuff isn't going to work. Not that it's going to work too well, but that it's going to fall short or not be a significant enough contribution, or it's not going to be stimulus because it never is.
Well, as Major Marquise Warren from Quentin Tarantino's Hateful Eight said, let's slow it down. Let's slow it way down. When did gold start rising, if not in response to the most recent central bank actions?
Yeah, I think that's an important point to start with, because I think the mainstream conventional interpretation is that this gold and this massive spike in gold began in March when Jay Powell started doing all these QE and bank reserves maneuvers, and the government started building up its Treasury General account and spending and the CARES Act and all these other things. And of course, Europe is doing the same stuff, and you have globally coordinated response to what happened in March. And I think the perception is that gold's rise began in March, and therefore it's essentially corroborating the idea that the Fed is being inflationary, when in fact that's not really true. If you look at where gold started rising, it was all the way back in October of 2018. So a year and a half before Jay Powell ever started with his QE nonsense and all the other stuff that the central banks have done in the wake of the COVID shutdowns and global financial crisis #2. It actually began in early October of 2018 as a culmination of what had happened prior to that, which was all of these deflationary signals in the euro-dollar futures curve. The dollar itself, for example, began to rise in April of that year. And all of these things that built up over time that were saying, look, these pressures in the dollar system are getting significant such that they're probably going to break out and cause all sorts of damage. So when we got to October of 2018, that's what we really saw, is those things that had been building underneath the surface before that and during 2018, they started to become serious.
The things that I can think of, the dollar stopped falling in January, then started to rise in April. On May 29th, the US Treasury market and German bonds exhibited a full-body dry heave. There's a sharp fall in yields. And then as you said, the euro-dollar futures curve inverted. Things were going badly. But then what happened from October 2018 to February 2019?
Well, then we got our first real taste of what we've called euro-dollar #4, which was essentially another global dollar squeeze. And in terms of gold and bonds, what we saw was bond yields started to fall precipitously, and the yield curve began to join the euro-dollar futures curve in inversion. Long before everybody talked about inversion last summer, which most people watch the yield curve and they only look at specific parts of it, whether like the 2-year, 10-year, or the 3-month, 10-year, those kinds of things. When very discrete parts of the yield curve had inverted long before last summer. And what happened in terms of gold, as all that was going on in the bond market, these deflationary signals, this demand for safe liquid instruments and liquid assets and hedges, the gold price spiked. And it was obviously not because of the inflationary scenario that Jay Powell was still selling at that time, which was, by the way, that was the mainstream convention in the media, as well as all these so-called bond kings running around the media telling you that interest rates had nowhere to go but up. Instead, gold was rising in direct tandem or inverse tandem with bond yields falling and the yield curve twisting into these various small pockets of inversion. So these were very clear deflationary, not depression, but deflationary downturn, globally synchronized downturn signals that are not consistent with the mainstream interpretation of gold going up because of money printing and inflation.
But then from February to May of 2019, the two disagreed.
Yeah, there was a bit of a divergence, and this happens from time to time, where the gold price began to fall while the bond market continued on in its trajectory. The bond market continued to say, hey, there's still problems going on. And you can attribute the decline in gold price since late February 2019 to a couple things. I think there was collateral issues that started to show up in the repo market, especially in terms of repo fails. We saw a spike in fails around that time. But even if you look at it as the opposite of what happened before then, maybe it was some people started to believe what had happened in monetary policy terms, which was Jay Powell, who was supposedly aggressively hiking rates because of its inflation and accelerating growth in late 2018. Remember, in early 2019, what he said was, we're going to start pausing. And that was supposed to be an enormous help because a lot of people attributed it to these, these signals of these negative signals in the economy across the entire world as, maybe the Fed was causing it with its rate hikes. Therefore, if the Fed pauses, maybe that makes things a little bit better. But for whatever reason, from that point, for a couple months there, gold was a little bit softer while the bond market continued to signal its negative, all these negative things.
Yeah, as you often say, nothing ever goes in a straight line. And that's why we want to look through multiple independent lenses to try to corroborate a story. From May through September of 2019, I was trying to earn a few extra euro dollars by applying sunblock to wealthy ladies at the Grand Cayman Marriott. What was gold and bonds, US Treasuries? What were they during this time period?
Yeah, last summer was when people really started to pay attention to the yield curve. And again, it's frustrating because you should always pay attention to the yield curve, not just in these specific instances where specific pieces of the yield curve, invert or tell you something that we're supposed to believe along with mainstream convention. What we had was essentially what everybody called a recession scare. We can debate whether it was a scare or not, but there's no doubt that for a period there, especially in August of 2019, it really seemed like there was some really serious stuff going wrong. And in terms of the bond market, you saw massive inversion. The yield curve inverted pretty much across the whole curve, even the parts that people watch. So that's why they started watching it. Well, at the same time, as we're getting this downturn, contraction, negative business cycle signal in the bond market, the gold price, skyrocketed. It spiked. It went way higher. And it wasn't because, again, of inflation. It was not Jay Powell. It was not the Federal Reserve. It was not inflation. In fact, it was the opposite because we were starting to see disinflation throughout markets as well as the global economy. So again, gold and bonds moving in for the same reasons at the same time, and it wasn't inflation and money printing.
No, definitely. The economy all around the world was struggling. And if you weren't paying attention to it because we didn't have our show up at the time, of course, people could have been reading you at Real Clear Markets and at Alhambra Investments. But if people weren't, they sure got woken up in September, in early mid-September. Something happened. What happened from September 2019 through the end of the year, gold and bonds?
Well, we finally had a repo market rumble, something that finally signaled that, hey, this stuff is really getting serious. But even before then, we had, the ECB, which Europe's downturn was a little bit more advanced than what we saw here in the United States and elsewhere. So in early September, I think it was September 12th, even before the repo event in mid-September, the ECB restarted QE again, having stopped it the prior December. So you had central banks starting to become more active again, and more active in the way that we are told to consider them. So the ECB doing more money printing, quote unquote, with QE. And then after the repo event in mid-September, the Federal Reserve did its not QE, which was buying treasury bills and saying it wasn't doing QE, along with these repo operations or whatever else, which got classified in the mainstream media as money printing anyway. But what you see in terms of gold in the bond market is all of a sudden, the Fed and the ECB and these major central banks are doing the money printing, but yet the gold price is falling. Again, it's acting opposite. The yield curve actually started to move back toward a more normal situation during the same time period, which was essentially both of these markets together once again saying, well, let's give these central banks a shot. Let's see if it works. It wasn't a major move. It wasn't like the markets were completely buying into the premise behind this monetary, quote unquote, stimulus, but the markets were willing to give these new programs or these, restarted old programs, they were willing to give them a couple months a chance to see if they actually ended up creating, getting us out of that recession scare that had showed up in the summertime. So gold was down, the bond yield, nominal yields actually backed up a little bit, the yield curve went back a little bit flatter, and so things looked a little bit better for a couple months there.
Gold and bonds were strolling merrily down Lover's Lane when all of a sudden from out behind the bush comes the CoVo. It's got a billy club, it's got a wolf's grin, and it's hitting its hand like this. It's got a taste for mayhem. Everything went nuts once the virus came. What happened then? And then it seems like then people were, talk a little bit about the upheaval that took place, and then how people started to link the printing with gold's rise all of a sudden.
Yeah, I'm going to disagree with you a little bit there, Emil. It wasn't COVID that necessarily mugged the markets. In fact, when you look at gold and the bond market, these things started to shift away from that, hey, let's give them a chance, and then back into the what I call the oh shit phase, back in the early part of December. So long before we had even heard of COVID, long before we even heard, weeks before anybody had heard of an outbreak in China, while it was obviously going on in China, but nobody really knew about it, the gold price started to go higher. The yield curve started to twist in the wrong direction. The nominal yield started to fall again. So we got the deflationary negative signal all the way back in early December. And then along came COVID. It made everything that much worse. And so as we got, this, what I think was the development of the Eurodollar number 4 getting more serious in terms of the downturn there. And then on top of it, we add the prospects of what is this COVID shutdown going to do? What is the COVID outbreak? It wasn't a shutdown, but what is this COVID outbreak going to do in addition to all of these negative factors that have been presented to us for more than a year by then? And that's why you see gold price again skyrocket. You see the yield curve fall apart even more. Bond yields start to drop long before we get to late February, which was, global financial crisis number 2. And in global financial crisis number 2, first half of March, everything just went haywire. And in terms of gold behaved exactly the way it had during some certain parts of the first global financial crisis, which was strictly as collateral of last resort. So as we saw the repo market, the collateral bottleneck actually show up, that dragged gold price down quite dramatically, especially on the very same days that we saw the outbreak in the collateral part of the repo markets. So essentially during the first half of March, these markets just went haywire because that's exactly what everybody was anticipating all along, that these negative deflationary type pressures were going to create a situation that would look like the first half of March.
Jeff, I have just 2 final questions as we're running out of time for this segment of the show. Gold as collateral of last resort. Who is holding this gold and selling it? Who is using it as collateral of last resort? And, well, you answer that one, and then I've got a follow-up about how you end your article with gold caps that you suggested.
Yeah, you want me to name names? Is this Joe McCarthy time? Who's anybody?
Hedge funds, insurance companies, foreigners, central banks.
Well, central banks sometimes have been a supplier of bullion into the market. So you start with bullion banks who have supposedly access to unencumbered or unallocated gold stores that they can then lend in the marketplace in lieu of treasuries or other kinds of financial capital. And as they're used and mobilized that way, whoever's receiving it on the other end, whoever's lending cash based on that collateral, doesn't want physical gold. They don't want paper gold either, so it gets dumped. And therefore, once the gold is used as collateral, it gets essentially mobilized and dumped on the marketplace, usually all at once, and usually in the early morning illiquid part of the hours, or illiquid part of the trading hours. So that's why we see these early morning gold slams that often happen in direct tandem to the, what we saw in the T-bill markets, for example, where yields would prices of T-bills would skyrocket and their yields would drop at times in March below zero, well below zero.
Final question. At the end of your article, you say, quote, Powell would be better served ditching his flirtation with yield caps, buying treasuries, and instead proposing to impose them on gold by selling paper bullion. Then again, he doesn't actually need a gold cap because right now everyone is spinning higher gold just the way he wants them to. Jeff, what is this theoretical idea of a gold cap?
Well, it's not a serious idea. It's really trying to make a play on the fact that gold right now is signaling that Jay Powell and Christine Lagarde and Corroborated and everybody else, they're failing. They're not meeting their mission. Their mission is to convince the world that everything is fine. They've got everything handled, everything covered. Therefore, don't worry. The recovery is coming. Don't think about selling assets. Don't think about firing workers. Don't think about anything bad because we've got it all covered. And what the rising gold price is saying, no, you don't. You don't have it covered. We're really nervous this is going to turn out to something not just like March, but maybe worse than March. These deflationary pressures that have been building for a couple of years now that have been amplified even further by the coronavirus. What does that look like if it gets even worse? So the gold price rising is not inflationary. It's a central bank error hedge that says Jay Powell is failing. But since Jay Powell has this myth and convention on his side, and of course the entire financial media, it's being spun as inflationary. It is an inflationary signal that would signal that Jay Powell's being successful, that he has printed a lot of money, that is going to lead to inflation, and therefore he's been overly successful. So the idea is if people interpreted gold prices correctly, then he would really need to cap them in order to get them to, to get the gold market to shut up and telling everybody that he's failing, not succeeding, he's failing.
Well, this is going to be a controversial article, I feel, and a controversial segment. But if anybody wanted to ask questions about it, they can do so in the YouTube comment section. They can do so on Twitter. They can find you at @JeffSnyder_AIP, and they can find me at Emil Kalinowski.